My name is Blake Workman. I'm one of the many financial advisors here at InfiniTALKS. I'd like to thank you for your morning, lunchtime, or afternoon, depending on when you're taking some time to watch this video. As I'm starting the presentation, I'll be followed up with other advisors here in the office, Brooke Deaver, Jerry Perfect, Sam DeSetti, Melissa Myers, and then I'll be back to finish it all out. We're going to keep it on a very high level today, so if there's anything that piques your interest during the discussion today, please reach out to InfiniTALKS and your advisor to go in a deeper dive for it. So we're going to talk about the big beautiful bill and the tax implications that it has for this year and next year. So page 1 of 900. No, I'm just kidding. Like I said, we're going to keep it on a high level. So this bill was just signed into law here on July 4th of this year. As I just said, there are 900 pages that it affects everything from taxes to healthcare to energy, etc. So there's a lot of things in this that we're still going through, but we want to make sure that we hit on the things that are going to affect you today and what we can plan on. Also inside of there are some things of that Jobs Tax Cut Act of 2017 that have been made permanent. So we'll go over those things here throughout the discussion. To kick it off, I'm going to talk about two deductions that affects most of us. The first one being that standard deduction that we get to take on our taxes at the end of the year. Currently, if you're single, that's at $15,000. Married's at $30,000. Here we're going to get an automatic increase for this year of singles going to $15,750. While married, you're getting that bump up to $31,500. So that's for those of us that standard deduction. So you get that right up the top of your taxes. So that increase is a good one, and we'll see what it affects for next year. The other one that's getting another increase for a tax deduction is what we call the state and local tax. We also call it SALT for short. For those of you that have high state taxes, high local income, sales taxes, high property taxes, those types of things, and you are itemizing your taxes, this SALT is a great thing to take advantage of. Currently it sits at a $10,000 deduction. Well, that's jumping up all the way to $40,000. It's only doing that until 2030, and then it'll revert back. So those of you that are those high income earners, you may want to take advantage of this SALT deduction jumping from $10,000 to $40,000. And again, if you have any questions further, please reach out to your advisor here at InfiniTALKS.
So one of the more popular provisions and one that's gotten more attention in the press is a new $6,000 per person deduction if you're over age 65. So $6,000 per person, $12,000 for a couple, and it's an additional standard deduction on top of the already standard deduction that's a little bit over $30,000. So I think one of the reasons this has gotten so much press is because the way the Social Security Administration interpreted this is it will effectively make Social Security not taxable at the federal level for about 90% of Americans. There is a phase out that will kick in above certain income thresholds, and again, it's not specifically to keep the taxation of Social Security low or eliminate it, but effectively it does that. It's geared toward people age 65 and over, and it will phase out or end after the 2028 tax year. Another provision that's gotten some attention and been quite popular is an additional deductibility for tips and overtime pay. For tips, an individual can deduct up to $25,000 of tips that are received from their taxes that would normally be included in their taxable income, but it will now be excluded through the 2028 tax year. In addition, for overtime pay, there is a deduction from federal taxes for up to $12,500 for individuals and $25,000 for married couples, where they can exclude overtime pay from their federal taxes as well. Again, both provisions do have a income threshold where they begin to phase out at, but that will be pretty valuable for people in certain occupations. There were a couple of provisions related to child tax credits that also were increased and made permanent. There's some complexity to those, so I would just suggest either visiting with your tax preparer or visiting with your advisor to get more of the details. But the key is the child tax credits have been increased, will be indexed for inflation in the future, and are made permanent. They won't phase out at the end of some particular tax year. So 529 plans continue to grow and be enhanced in the different ways that folks can save money and get tax-free withdrawals from their 529 plans. And the way that was expanded in this particular piece of legislation is they've now added credentialing costs for post-secondary education as a deductible expense that can be paid for with 529 plan dollars. Again, we'll have to look and see what the final details are of this particular provision, but it sounds like people getting credentials, i.e. initials behind their name by studying and taking tests, will be able to pay for that cost via a 529 plan. And again, the benefit of the 529 plan is once you've made contributions, which can be deductible for state taxes in some states, all of the growth that occurs there is tax-free, and withdrawals are also income tax-free. An additional change to 529 plans is that they have further enhanced different expenses associated with elementary and high school related expenses. They're adding the ability to deduct some additional materials such as books or tutoring program costs and additional education classes outside the home that may have a cost to them that aren't tied to the school someone's attending. So again, the spirit of that was just to include additional items that can now be paid for with those pre-tax and tax-free dollars. And then finally, there's a new deduction for interest on automobile purchases. This one, as I read through the details, had a great deal of nuances and what-if scenarios in it. But essentially, if you're buying a new car that's been fully assembled or final assembly in the United States, and you take a loan for that car, you can deduct the interest on that up to $10,000 per year. Now, one would have to buy a pretty expensive car in order to take advantage of the full $10,000, and there are phase-outs. It looks like at $100,000 of income if you're single and $200,000 of income if you're filing jointly. But if you do buy an American assembled car, that's new, you can deduct that interest expense from your taxes. And all of the things that I went through here in the last couple of minutes that are deductions are outside of the standard deduction. So it won't get lost inside your standard deduction if you're taking that standard deduction, which has gotten larger over the years. It'll be in addition to that if you qualify based on the provision and aren't phased out from an income perspective.
I'll be talking about some of the changes for us as individual filers that are effective in 2026 and beyond. If I use the term permanent, understand that in Congress, permanent means until it isn't. So we'll go over things as they stand today, but know that things will change in the future. So the first area I want to talk about and cover is the estate tax exemption. Starting in 2026, the amount that is exempted from your estate from taxes is going to be $15 million for an individual and $30 million for a couple. Most people are going to be covered by that, and that's good news. The second thing I want to talk about is the gift tax. For 2026, and this amount may change based on inflation, but as it stands right now, the gift tax exemption, meaning what you can give to an individual without having to file a gift income tax return, is $19,000. If you're a married couple, you can each give $19,000 to the same individual for a total of $38,000. If you stay within those limits, that does not detract or subtract from your lifetime exemption of the $15 million for individual or $30 million for a couple. Next thing I wanted to touch on are what the tax rates are going to be for us as filers. In 2026, we're going to have tax rates of 10, 12%, 22%, 24%, 32%, 35%, and 37%. So hopefully that's enough. And thank goodness they didn't put decimals after this to confuse us even more. Each filing status has different income levels associated with it. So depending on if you're a single filer or unmarried, if you're a head of a household, if you're a married couple filing jointly, or if you're a married couple filing individually, all the income brackets are slightly different. I'm not going to go into those details. They're easy to find on the internet with just a quick Google search. In the way of a quick reminder of how our taxes work, there are two terms that I'll just reinforce. You probably already know these, but one is the marginal tax rate. Marginal tax rate simply means the highest rate that your income is going to be subjected to. So if you're making currently, filing jointly, if you're making more than $750,000, you're going to find yourself in the 37% tax bracket. The other term I'll introduce, though, is called the effective tax rate. And this just reinforces our tax structure. We're a progressive tax system, meaning that in this situation, the first $24,000 of income on that high earner is only taxed at 10%. The next band that you hit, those dollars are going to be taxed at 12%. So you're going to walk your income all the way up until the top level. So your effective rate is what you actually end up feeling from your checking account when you have to write the check. So the marginal rate is the top rate that's exposed to taxes. The effective rate is when you blend all the lower rates together, what you actually end up paying. Next thing I want to touch on are some of the deductions. Now the standard deduction has already been covered. If you're one of the very high net worth, though, you may still be itemizing, in which case your home mortgage deduction may be important to you. You can deduct up to $750,000 of your home mortgage expense, and you can possibly, and this is something you'd need to verify with your tax preparer, you can possibly deduct some of your home mortgage insurance premiums. As I mentioned earlier, the standard deduction now is relatively high, and most people just take advantage of it and don't itemize anymore. One of the changes in the One Big Beautiful Bill, though, is they're allowing an above-the-line deduction, is how they refer to it, for charitable contributions. Going forward in 2026, for an individual, and these only pertain to cash donations to a charity, you can deduct an additional $1,000. If you're married and filing jointly, you can deduct up to $2,000, again, in addition to your rather generous standard deduction. I'm going to read for you because it's so convoluted, but I'm just going to go ahead and read the language. So if you are itemizing, though, here's how this shakes out. Charitable contributions will need to exceed 0.5% of the taxpayer's contribution base to be deductible. The contribution base is defined by the Act as adjusted gross income without any net operating loss carrybacks. Again, this will affect very few of you listening to this. If you do find yourself in that situation, you can just go to your tax preparer to find out what that actually means. The other one is itemized deductions. And again, this will be only pertaining to those who are going to itemize and need more than the $31,000 of standard deduction. Here we go. The amount an individual taxpayer can deduct after deduction-specific limitations are applied must be reduced by 2/37 of the lesser of the total amount of itemized deductions, or so much of the taxpayer's taxable income for the taxable year as it exceeds the dollar amount at which the 37% tax bracket begins with respect to the taxpayer. Thank you, Congress, for making that so crystal clear. Again, if this applies to you, and it will apply to very few, you already have a good tax preparer and they'll be able to guide you through that. The last one that I'll talk about is the easiest one. Miscellaneous itemized deduction. There aren't any anymore. They've been permanently deleted. And again, permanent means until they're not.
Some additional changes that'll help business owners, savers, and families reduce their tax liability and grow their wealth starts with the qualified business deduction. This is for business owners with pass-through companies, which may be LLCs, partnerships, S-corps, or sole proprietors. They can deduct up to 20% of their business income for the purposes of their own personal taxes. The deduction that was previously set to expire at the end of 2025 is now extending through 2032. The income thresholds are also being raised and tied to inflation, so more business owners should qualify for this. Certain businesses, like tax firms or consulting firms, will gain a partial eligibility at higher income levels. An additional provision is the alternative minimum tax. This is a separate tax calculation. It's designed to ensure that high-income taxpayers pay at least a minimum in their tax. So even after the deductions and the credits. So starting in 2026, the exemption amounts are going to be significantly increased, so fewer households will be affected. Now, exemptions are going to be automatically adjusted for inflation to avoid kind of a creep into a different tax bracket, especially for middle income earners. And any unused AMT credit or alternative minimum tax credit can be applied more quickly to reduce future tax requirements. Additionally, ABLE accounts help individuals with disabilities save for qualified expenses while keeping their growth tax-free. So the annual contributions have now increased. They have been aligned with the standard deduction of roughly $16,000 for 2026. The eligibility has also expanded to people who are under the age of 46. Now, earnings on these accounts can now be grown and invested in additional tax advantage options, such as treasury-linked investments and a few other mutual fund investments as well. Lastly, new in 2026 are the Trump accounts. Now, this is a new tax-advantaged investment vehicle for individuals and their families to help build long-term wealth for their children. Some of the features are a contribution limit of $5,000 per individual annually. But children that are born between 2025 and 2028 can get an additional $1,000 credit for contributing to their Trump accounts. And now, while we're still learning more about these Trump accounts, the goal is to encourage early savings for children, for early investment growth for the purposes of expenses such as education or first-time home purchase. Now, what all these provisions mean for you, these changes open new opportunities for business owners, for families, for savers to keep more of what they earn.
If you are a business owner or if you are a key decision maker in a business, I'm going to help you unpack and learn all about the deductions your business can start taking or the changes that were made. So first, we're going to talk about the bonus depreciation. This one is by far my favorite because I think it impacts everyone the most broad. So the bonus depreciation is you can now take 100%, there's no more limit or cap, 100% of the deduction, right, or the depreciation of a piece of equipment, a vehicle, a major software that you need to implement into your company. So prior to this bill, there were limits and you had to spread it out over several years. Bonus depreciation, you get to take even more, and the fact that you can take 100% in the first year that you bought it is a big deal and can impact you for 2025. Now, you do have to make sure that this was purchased January 19th, 2025, so that day or after. So if you bought something on New Year's Day, sorry, you can't deduct it at 100% with the bonus. You're going to revert. The next one we're going to unpack is a special provision for production property. So what does that mean? So if you are in the film industry, the music industry, or you are developing something within your company, this provision allows you to take even more of a deduction. So it's different than the depreciation. So the cost that you're going to incur, as long as you're building it right here in the United States, then your company has even more deductions that it can take advantage of that didn't exist before this bill. Okay, the next provision we want to talk about is pretty specific. So Section 179 of expensing, there were limits that increased. So before, you had a cap. If you're a big corporation that's spending a lot of money, you had a cap on how much you could expense. With the changes, small and medium-sized businesses get an instant deduction, again for equipment, software, up to $2.5 million. So the previous was around $1 million, so you get an extra 1.5. That's a big deal if you're a growing company that's trying to expand. So there is a phase out that you need to be aware of. So you can only do this expense, right, up to the 2.5, but there is a phase out provision in here. It gets a little tricky, so I would definitely default to your accountant to help you unpack this if this impacts you. So the next detail that we want to unpack is specific to research and development. So again, the theme here is taking deductions. If you're spending money or reinvesting into your company, this bill incentivizes you and is trying to help you take full advantage of all of those deductions to help you reinvest into your business. So for the R&D, research and development provision, this allows you, if you're going to do expansion right here in the United States, you have even more deduction at your fingertips. So again, if you are expanding, talk to your accountant to better understand how this provision changes can help you. Now let's walk through the qualified small business stock exclusion. So if you have stock from a C corporation, what changed in this exclusion is, one, the threshold went up for the company assets. Again, the bill is trying to encourage growth of companies. And so why not offer you an exclusion if you own stock directly to say, hey, I'll allow you to not have capital gains tax on this specific stock if you meet these requirements. So it's important to know that you can get 50% tax-free if you hold it for at least 3 years, okay? So there's definitely some timing here you gotta understand. If you hold it for 4 years, 75% of your gain is gonna be tax-free, and if you hold it for at least 5 years, you get 100% tax-free gains. So again, if you are one who has stock in a C corporation, this is a big benefit to you. Now, all of the provisions I just walked through are effective in 2025, but there were definitely some key dates, so I hope you wrote those down, or you can come back, watch this again, write down those notes, and go talk to your tax professional. And again, those were for 2025. The next provision I want to talk about is not effective until 2026. If you are a company that gives to organizations, 501c3, you have a group that is focused on charitable giving, then there are some provisions that take effect in 2026 that you need to be aware of. So there are 2 rules now. In order for your business to deduct some of those charitable donations off of your business income, there is now a floor. So you have to give at least 1% or more of your business income. If you give under the 1%, fabulous, right? But you can't deduct it off of your income taxes. If you give more than the 1%, then you can deduct it up to 10%. If you were to give more than 10%, then there is a carry forward provision where you could carry that forward to next year's tax return. But again, this starts in 26, so that carry forward would start in 27. A quick example for you would be if you are a company, your income is $1 million, then you would have to give more than $10,000 to get a tax benefit. Now, let's say you gave $5,000, you can give $5,000, you just won't get that tax benefit, okay? Now, if you were to give up to $100,000, that is what you could deduct for 2026, and then you would have that carry forward provision moving forward. If you have any questions on this specifically, I would highly recommend talking to your tax pro because this might change how your organization decides to give.
Thank you for taking your time today with us. I know it is valuable, and thank you all advisors here at InfiniTALKS for your time. It was very knowledgeable. I hope you learned something from here that it not only affects individuals but also business owners, whether you're married or filing jointly or single. It affects all of those things. So if anything brought to your attention, please reach out to the information that we have on the screen to your individual advisor here. And also remember to always reach out to your tax advisor before making any full adjustments.